Welcome back, everybody, to today's Market Explained, a FourStar Media Experience. Brian Kasal, your host. I'm here with my co-host, Mr. Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Glad to be here. Glad to talk a little bit about the markets today.
Excellent. Chris is the Director of Development of FourStar, and he runs the product development, portfolio management, operations, recruiting, everything about developing the firm and the growth of the firm. And he's also a Cleveland boy, loves his Indians. He's got a golden doodle puppy, and he's my co-host on the show again. Chris, welcome.
Thanks, Brian. Glad to be here.
And I'm Brian Kasal. I'm your host, the CEO of FourStar Wealth Advisors, also philanthropic advisor for insiders and other wealthy investors. We're also advisors to insiders, as I said, to corporate executives. I'm father to the sons Evan and Quinn, and husband to the amazing Tripty. We are starting out on our traditional program today. We're going to talk about the economy. We're going to talk about the markets. Then we're going to talk about interesting things that we see out there. So, Chris, why don't we get started? We've seen some changes in the market relationships between all the major asset classes now. So what are you seeing?
Yeah, I mean, we are seeing some interesting movements. It's really a matter of the haves and have-nots, I would say. So the top three asset classes, we saw improvement, and the bottom three asset classes continue to kind of move downwards or deteriorate. So domestic equities is still holding the number one spot by a pretty wide margin. It has 320 tally points, and it actually gained 3 from the last podcast. So strengthening there, still seeing some strengthening relative to the other asset classes. International equities is in the number 2 position. It's at 259 tally points. So a bit of a gap there. It gained 2 tally points from the last podcast. So continuing to gain a little bit, but not at the pace of domestic equities. The biggest mover and the biggest, I would say, winner, if you will, even of the asset classes is commodities in the 3rd position. So we saw a 24-point movement upwards, and it's at 220 now. So still has a little bit to go to start challenging in that number 2 position for international equities. But the trends are there. Obviously, oil, gold, even industrial metals, things like that have really been booming really in the last month. And then in the bottom 3 asset classes, we have cash. That's at 131, and it was -9. So continued deterioration there. Currencies is at 85 tally points, -9 as well. And fixed income is at 74 in last place. So it continues to pull back, and that's at -10 tally points. So really a have and have nots, and the biggest winner really being commodities, and really the bottom 3 asset classes, cash, currencies, and fixed income, all deteriorated almost at the same rate. So, really interesting market. It's really interesting to see commodities kind of come roaring back over the last month or two.
Yeah. So this thing with commodities, Chris, look under the hood, what are the main commodities that are moving?
Well, gold's a big one. Gold actually just hit a new high, and it continues to run today. So gold's a big one. Oil, though, has been on a tear. Brent crude is up almost 19% year to date. West Texas Intermediate's up almost 22% year to date. And a lot of that's, we have tensions continuing in the Middle East. We recently had, I think, Israel did some bombings in Syria and killed several high-level Iranian kind of generals for their IRG, Iranian Revolutionary Guard. So continued tensions there, and now Iran's looking to strike back. So that really has oil on edge. So that's going to be interesting. But then we have movements out of industrial metals. A lot of that's based out of some of the economic signs we're seeing out of China. And like I said, gold, even silver, precious metals along those lines. I think that goes along with the geopolitical tensions that are happening globally, as well as just currency risk. I think we have the Federal Reserve, people are out there challenging if they're even going to cut rates this year. So we are seeing the dollar strengthen, but really the rest of the world, and this is a global marketplace. The rest of the world is looking to cut rates. I think the European central bank will probably cut in June, if not some point in the summer. So really the rest of the world is looking to lower rates. So even though the strong dollar is there, I think due to risks, currency risks, things like that, where we're seeing gold continue to hit new highs.
Yes. So it's created an environment, Chris, where because commodities are moving and we've had some very sloppy markets. We saw the CPI number came in hot again, third month in a row, and then everything collapsed for a little while, and then we had a little mini technology rally. Technology has been weaker this year. It underperformed the S&P for the first quarter, and now we're seeing a little bit of a mini rally in technology names. Apple, for example, had been down 5%. Now it's up big. And so, tech actually went through a huge cost cutting regime last year. I remember there were 10,000 layoffs here, 10,000 there. So a lot of people lost their jobs. So they've reorganized. Never really had to do that in technology. It was always growth. Now things are changing. They're a little more stable, a little bit more integrated into the economy. And so they're having layoffs and doing things like normal companies do. But it's helping their earnings. So we expect the earnings season to be pretty good with technology. And then earnings begin this week and today with JP Morgan, Chris, right? JP Morgan had good earnings.
Yeah, JP Morgan had good earnings. I want to say Wells Fargo had theirs as well, and theirs was not as good as JP Morgan's. But, I think they're going to be the bank earnings, I think are going to be mixed. They definitely have some headwinds against them with the high interest rates, but there are certain things they can take advantage of, and obviously JP Morgan did take advantage of them. I think what's going to be interesting is we had a really, really, really strong Q1 earnings, which definitely helped propel those great numbers and great stock market numbers we saw in the first quarter. I think Q2 here, though, it's going to be a little bit more mixed. So I think it's going to be interesting to see, and it's going to be a good telltale as far as maybe what the rest of the year is going to give us. So maybe technology, like you said, Brian, you may have the Apples that might stocks like Apple that maybe get a bump upwards here. You have other stocks that may underperform in earnings and might be taken down a little bit. So I think it's definitely going to be more of a mixed bag than that first quarter we saw.
So more on the markets, Chris. Gold, as you said, is at an all-time high, and oil is running now near recent highs. The high was still in 2008 at 140 something dollars a barrel, but oil is running anyway. Copper is running. And then there's a militia in the Middle East that's causing disruption in the Gulf. So that's causing more issues for the economy. And then the Baltimore Harbor, obviously the bridge collapse is disrupting trade. So there's some interesting effects of all these things. And some of it's positive, some of it's negative. Certainly if commodities are running higher, that's fine for the commodities for now, but long term that's not a good thing because commodities are a cost to business and to consumers. So if prices go higher, unless you're the owner of the commodity, it's usually a problem. So hopefully we don't see a huge commodity run like we did in 2022, but it also was a sign of a weaker economy. Now, Chris, you did some work on the international side on China. Why don't we dig into that?
Yeah, so as we kind of talked briefly about, one of the commodity metals we're seeing running is, like Brian said, copper, aluminum, some of these industrial, these building metals, and a lot of that's out of some of the numbers we're starting to see out of China. The Chinese exports for Q1 came out, and they're actually 1.5% higher than in Q1 in 2023 or a year prior. Some of that was due to the strong dollar. The dollar was up 4.4% during that period. So stronger dollar means it's cheaper for us to purchase those Chinese goods. So exports usually tend to increase when we see that imbalance there. But with that, we're also seeing friction abroad. So countries are looking at the Chinese government, which has been known to do this, but they are subsidizing and providing support for their manufacturing, and that's allowing them to undercut domestic companies. So, even though we're seeing Chinese exports rebound, it'll be interesting to see if this continues or how much, before it gets clamped down on by the U.S., by the EU, things like that, because that is definitely a game that the Chinese government or regime is known for playing. So we'll see how if that can keep up. And then we got the Servicing Purchasing Managers Index, and that rose to 52.74 in March from 52.5 in February. So anything above 50 is an expansion, and that's that their servicing sector continues to increase there. So some better reads if you guys have listened to this podcast regularly. In Q1, pretty much every number that came out of China was negative. So now that we're starting to see some positives, the global market's getting hopeful that we're going to see a rebound there, and that's where we're seeing some of this movement, especially in the industrial metals and oil to a degree as well, I would say. And then staying in the same region, but jumping over to Japan, really interesting things going on there. We talked at the last podcast about how the Bank of Japan had just brought rates out of negative to neutral. That was about a month ago now coming up on. But it's really interesting how the market took that, because instead of strengthening the yen, it actually weakened it. So what the market expected was maybe more of a move there, maybe to positive, not neutral, but positive interest rates. So they took that as maybe the Bank of Japan thinks that the Japanese economy is weaker than expected. And so what's going on here is the Japanese yen is now trading at 153 yen per dollar, which is about where the limit, that's where the limit is that the Japanese government or the Bank of Japan said that it would intervene. And that's a 34-year low, to give you some perspective. So the Bank of Japan is really in a tough place here, because to help the yen, to strengthen it, it would need to raise interest rates. But the fear is if they continue to raise interest rates, then they threaten to strangle off the Japanese economy. So really an interesting balance going on there. And quite frankly, one we're kind of playing. It's a little bit different, but in the U.S. right here as well, we have an issue with a very, very strong dollar going on in the U.S. right now. But it'll be interesting to see. And every week we're getting more and more news out of the Bank of Japan, which usually this isn't in the spotlight. But it's a big player and something that's not being, I would say, reported on enough.
Yeah. Interesting. And kind of going through that and the economy, you mentioned hot numbers, Chris, for the CPI, that's come out. It's almost like the Fed is in kind of a box, aren't they? I mean, because aren't the deficit numbers pretty massive for the first 6 months again? And that's creating pressure to lower rates, but they may have to raise rates. So what do you say about all that?
Yeah. I mean, it's, the U.S. government ran $1 trillion deficit for just the first half of the fiscal year. So that's remarkable in a bad way, I guess you could say. But the concerning aspect of that is the net interest expense. So the expense on the debt is $429 billion. And that's just below how much the national defense expense is, which is $433 billion. So if we just ran up another $1 trillion in deficit, let's say we run another $1 trillion, that net expense is it's just adding to it. The more interest expense we get, the more we're going to have to run into more debt, and the more we're going to have to raise. So it's a snowball rolling downhill. So it's only going to balloon further. And with higher interest rates, when we were at maybe 2% or 1% interest rates on this debt, wasn't as big of a deal. It's still a big deal, but now at 5% interest rates, that makes things even worse and accelerates it. So the Fed is really at this, like you said, Brian, between a rock and a hard place, because they really need to. If they don't lower interest rates, this is going to happen sooner. We're going to either see a default, or they're going to have to print money. But if you print money, you're going to see inflation. So it's kind of a no-win situation. And as you said, Brian, the CPI came out at 3.5% in March, which was a continuation of the hot reads we've seen, in there. And there are certain industries that have certainly had bigger effects. I thought one with that CPI read that I think a lot of our listeners are probably feeling is auto insurance. So auto insurance has rose 45.8% since December of 2021. So huge increases there. And then at the grocery store, I think a lot of people, inflation has come down, but a lot of people don't realize that grocery store prices are still 36.5% more expensive than they were in 2019. So if you go to the grocery store in 2019, you spent $200. If you bought those same items today, it would cost you $272. So we continue to see this drag really straining American families.
It is. Well, and so the inflation is really a problem. President Biden, however, is saying that we're going to lower rates. So lowering rates, puts money in the economy and it's better for everybody. But when the inflation is hot and you lower rates, then obviously that's going to cause more inflation. Recently, at the podium, there's been a number of challenges to the administration. We were saying that Biden came into office. He had said that he came into office amid runaway inflation. Actually, it was only about 1% when he got in. Actually, many people think the president's policies and the spending caused it, not the other way around. So, and now with the minimum wage laws that are creating more and more pressure on companies, McDonald's, for example, is struggling with the minimum wage law. Pizza Hut actually canceled delivery in the state of California because of their large minimum wage law. So there's lots of issues there. So the economy is pretty complicated. Chris, what else you have?
Yeah, so the one last kind of hot read I would say from the economic perspective is we got a jobs number that came out, the March jobs number, and it came out really strong. It added 303,000 jobs in March, which crushed the expectation at 200,000. And average hourly earnings rose 4.1% year over year, which seems like a lot, but that's actually the smallest gain since June of 2021. So, I think, as you said, Brian, it's the self-feeding cycle, and it's really hard to get out of and we're already starting to kind of experience it. As we have increased costs, then that gets passed on to the consumer, and then wages have to increase. So it's, we have to see increased wages, which then costs increased prices, which then, it just kind of goes in circles and circles and circles until really we get to an unsustainable, level. And I would say I don't have it anymore. I think it got kind of too crumpled up, but I used to have in an extreme example, $1 trillion bill, I think it was Zimbabwe dollar, when they had hyperinflation. And you could imagine, going to the store and, buying a gallon of milk for $1 trillion, which seems ridiculous, but, it's really what that dollar is worth. So just a lot of interesting things. And I think, the next couple of years, it's gonna be really interesting because something's gonna give. I hope we find a way out of it, but it's really tough when for every dollar we take in tax revenue, the government's spending $1.33. So essentially, without us cutting 33% or cutting our budget by 36%, something like that, which I don't foresee happening. You'd have to have extreme budget cuts. You'd have to. It's something's got to give, and I'm not sure it's going to happen.
Well, Chris, it's complicated. We should be cutting our budget. We should be paying down some debt as well. I mentioned this on a previous. Responsible president might sell some assets and pay down some debt, not just the current yearly deficit. Get rid of the deficit and pay down debt. That's what we did after World War II, but we don't seem to have the will to do that. So hopefully, in the next term, if we get a different leader, maybe we'll get that changed, hopefully, because they need to not keep spending. Bottom line, though, is we came into this year assuming that the big interest rate increases were over, and they said we're going to lower interest rates at least 3 times this year. Well, that hope and that notion seems to be fading more and more by the day. And some interest rate observers are saying the next move actually will be up and not down, because inflation now is continuing to go back up. We had talked on previous shows here before that the inflation number of going back up is a big concern, similar to what happened in the 1970s when inflation was very high, and then it went lower for a little while in the late 70s, and it went right back up in the early 80s. So that was a negative, and they really lost control of the economy for a while there with inflation because there was so much excess spending in the economy So they had to raise rates to kill off the inflation. And that's what happened in all these other countries. We've now seen the third month in a row of inflation increasing. And if we keep spending trillion-dollar deficits every 6 months, or an average of 2 trillion a year like we did last year, besides having a debt problem in the future, we also will have an inflation problem, and that will cause the interest rates to go up, not down. Chris, what do we see out there other than what we discussed?
Yeah, so a couple interesting things. I think it was yesterday that we saw the passing of O.J. Simpson. He passed away at 76 from cancer. So obviously a very divisive person in the American eyes, if you will. But yeah, he passed away obviously yesterday from cancer. Then the eclipse, the big thing this week, especially kind of in Chicago, or I would say the from Texas all the way even to Ohio, was the eclipse. It happened on April 8th. And with people traveling to see it, to see the eclipse, it gave a $6 billion boost to the economy. So pretty incredible there. There's definitely a fever about it, a fever pitch that, people wanted to travel there. They wanted to go. So people were at restaurants. A lot of schools were off. Me being personally from Ohio, still having family there, I know a lot of my nieces and nephews were off of school because of the eclipse. So it was really interesting. Something obviously we don't see quite often.
Yeah.
And then go ahead, Brian.
Well, we had people leaving here, going downstate, going into different places, going to Indianapolis to see the eclipse, and we went up on the rooftop of our new residence and we were able to see it. We only had 94% in Chicago, but certain areas of the Midwest and going up into the Northeast had 100% complete dark out, unbelievable. And all the animals are going crazy. Everything was going crazy during the form. That's right.
Yep, well, exactly. And then on that same note, we had a rare magnitude 4.8 earthquake that hit New York City in the Northeast. So 4.8 isn't really that big. I saw actually posts afterwards of people kind of joking to a degree, saying that, how will we recover? And it was a picture of their glass that spilled over, or some little box that fell on the ground. Most people could feel it, but it didn't do really any damage. But obviously interesting. It's a rare occurrence when you have a earthquake in New York City.
Exactly. Well, good. Well, I think that's what we have. Just a couple things, Chris, to close here today. Leadership Matrix has a article about proactive healthcare and why that's important. And they're now showing, they've analyzed what it would cost if people were healthier on our insurance system, on our benefit system, and also on people's lives. If we do preventive healthcare, it's actually a lot cheaper long run, besides the fact that it's also good for us, right? So maybe we should eat better and have better health, and work out and all the things that you do to keep yourself in high quality, and have a long life and not have any health issues. So we're now recognizing that proactive healthcare is really an important thing. And so that we have a nice article about that. And then also up on the Leadership Matrix is going to be a link about our Diversified Alternatives Fund. And FourStar does a lot of work with investors investing in alternative investments. We usually set up portfolios of real estate and other types of business services, private placements that can earn, a 15 to 20% return, much more than stocks and certainly much more than bonds. But we also created a Diversified Alternatives Fund. And that fund is posted up on the Leadership Matrix, just some basic information about it. But if you're interested in learning more about it, you'll be diversified by investing in the fund. There'll be 15 or 20 different deals. Instead of getting K1s and tax paperwork and everything for every deal, you only get one K1 for investing in that fund. So it's a pretty good program. And we just wanted to put that out there just as a informational piece for our investors, and then any other investors that are interested in working with FourStar about that. So look for that in the Leadership Matrix. Chris, I think that's all we have for today.
Yeah, I think that about covers it. Covers everything going on in the markets right now.
Okay, so that's it for the eclipses until 2044, at least in the Midwest. And we want to wish everybody a great weekend. And thank you for being with us today. And we'll be back again with another episode of today's Market Explained. We're going to interview some folks as well. It's from the international trade. We're going to do some other interviews with alternative investment sponsors. And so in addition to some market commentary. So that's it today. Over and out. Thanks, everybody. Bye-bye now.